Since April 2020, the Comex has lost 153 million ounces of registered silver. Not eligible silver sitting quietly in a vault with no delivery obligations. Registered silver. The metal that physically backs futures contracts. The metal a buyer can demand at settlement. That number, sourced from CME Group's own daily vault reports, represents a 64% collapse in deliverable supply over roughly 6 years. And the drain is not slowing down. As of the most recent CME depository data available this week, registered inventory sits at approximately 86 million ounces, against open interest that, at its recent peak in the March 2026 contract cycle, represented over 400 million ounces of paper exposure. That is the arithmetic at the center of this story. 7 paper ounces for every 1 physical ounce that can actually be delivered. Here is what this video is going to show you. First, you will understand exactly what the Comex vault drain looks like in the data. Not in headlines, but in the actual numbers from CME Group depository reports and the Silver Institute's World Silver Survey, and why the pace of that drain matters more than any single price reading. Second, you will understand why the Shanghai Futures Exchange is telling a completely different story to Comex right now, and why that divergence between two of the world's most important silver markets is the structural signal that most commentators are glossing over. Third, you will understand the historical parallel that genuinely applies here, and the equally important ways in which it does not, so that you can think clearly about what this moment in the silver market actually means versus what people want it to mean. By the end of this video, you will have a framework for reading the Comex data yourself, rather than relying on anyone else's interpretation of it, including mine. The figure that keeps appearing in this story is 74 million ounces, the rough volume drained from Comex registered silver inventories between the September 2025 high of roughly 160 million ounces and today's level of approximately 86 million ounces. That is not a rounding error. That is not seasonal noise. According to CME Group depository statistics, Comex registered silver fell below 100 million ounces on February 11 of this year, when a single-day negative adjustment of over 3.2 million ounces in the registered category was recorded alongside withdrawals of more than 4.7 million ounces from the eligible side, in a 24-hour window. The February 2026 delivery period itself set a modern record, with 5,036 contracts, representing 25.18 million ounces, delivered in a single month, according to CME Group's month-to-date delivery report. The highest February delivery volume in the exchange's modern history, and that came after December 2025, when over 47.6 million ounces were claimed for delivery in the first 4 trading days alone, more than 60% of registered inventory at the time, in under a week. So let us be precise about what registered inventory is, because this distinction matters enormously. Comex vaults hold 2 categories of silver. Eligible silver meets the exchange's purity and bar weight standards, but has not been assigned a delivery warrant. Its owner has chosen to store it there without making it available against futures contracts. Registered silver has been warranted. It is the actual deliverable pool. When a futures contract settles physically, only registered silver can change hands. Eligible silver cannot satisfy a delivery obligation unless its owner voluntarily converts it. That conversion can take days. It is not automatic and it is not guaranteed. When people say the Comex has silver, they often conflate total inventory with registered inventory. And right now, that conflation matters more than it has in years. The Silver Institute's World Silver Survey 2025, the most comprehensive annual data set on global silver supply and demand, reported a structural market deficit of 148.9 million ounces in 2024, the 4th consecutive annual deficit. Industrial demand reached a new all-time record of 680.5 million ounces, driven by photovoltaics, electric vehicles, 5G infrastructure, and artificial intelligence hardware. The cumulative deficit across the 4-year period from 2021 to 2024 reached 678 million ounces, equivalent, as the Silver Institute noted, to approximately 10 months of global mine production. The 2025 deficit is projected at 95 million ounces, marking the 5th consecutive year of shortfall, 5 years in a row. Global mine production, meanwhile, rose only 0.9% in 2024 to 819.7 million ounces, and approximately 72 to 75% of that output comes as a byproduct of copper, zinc, and lead mining, meaning higher silver prices cannot independently stimulate the supply response that would be available in a primary mining market. Now here is the counter-argument that deserves a proper hearing, because it is not a weak one. The standard rebuttal to the Comex squeeze narrative goes like this. Open interest does not equal delivery demand. It never has. The vast majority of futures contracts are either rolled forward into later months or closed out before first notice day. Historically, only a small single-digit percentage of open interest ever stands for physical delivery. On that basis, the 400+ million ounces of open interest against 86 million ounces of registered silver is not nearly as alarming as it looks, because the exchange does not need to deliver 400 million ounces. It needs to deliver whatever fraction of that number actually stands. And that fraction, historically, has been manageable. The gold-silver research team has made exactly this point, explaining that delivery typically involves the transfer of a warehouse warrant, legal ownership, rather than bars physically leaving the vault. It is a paperwork mechanism, not a truck convoy. This is a legitimate point. It is correct as a description of normal market function. Here is where the data pushes back. The phrase, historically, is doing a lot of work in that argument. February 2026 was not historical. It was unprecedented. The delivery rate for February 2026, as calculated against the contracted silver outstanding, was running 12 to 22 percentage points above normal ranges, according to analysis published on CME Group data. Industrial users were standing for delivery immediately on first notice day, rather than deferring. January 29 saw 1,881 contracts delivered in a single day, the largest single-day February delivery on record. And speculative positioning, managed money, the leveraged funds, actually collapsed by 77% year-over-year in the same period, meaning the delivery pressure was not coming from speculators. It was coming from people who needed the metal. That is a structural tell. When speculation falls and physical delivery rises simultaneously, you are not watching a paper squeeze. You are watching genuine industrial and institutional demand drawing down physical supply. Here is what is not getting enough attention. The Shanghai Futures Exchange and the Shanghai Gold Exchange are not telling the same story as Comex. In late December 2025, the Shanghai Gold Exchange's spot silver contract, known as AG-T+D, settled at $78.55 per ounce. Comex silver futures were at $72.36. That is a $6 to $8 per ounce premium for immediate physical delivery in China over the Western paper benchmark. By some readings on specific dates, that spread reached over $8 per ounce, roughly an 11% premium. Now, in any functioning arbitrage market, that gap should close within hours. You buy silver cheaply in New York, ship it to Shanghai, sell it at the higher price, collect the spread minus transport costs of perhaps $1 or $2 per ounce, and repeat until the premium disappears. The fact that this premium persisted for weeks is the signal. It means the arbitrage is not working. Not because the math is wrong, but because when traders tried to pull physical metal out of Comex to ship east, the metal was not there in sufficient quantity to move. The SHFE simultaneously entered backwardation, a state where near-dated contracts traded a premium to longer-dated ones, meaning buyers in China were willing to pay more for silver today than for silver 6 months from now. Backwardation in a commodity market is how a market says, supply right now is tight enough that people are paying a premium for immediacy. That is not a paper phenomenon. That is a physical market speaking. China's structural position in this market compounds the pressure in a way that has received almost no serious mainstream coverage. According to multiple industry estimates, China controls approximately 70% of global silver processing capacity, both through direct refining operations and through processing of base metal byproducts. In January 2026, China implemented restrictions on silver exports, limiting outbound shipments to state-approved producers. The Shanghai Futures Exchange also announced stricter hedging quotas beginning in March, requiring market participants to demonstrate actual physical business relationships to justify their positions. That last measure is worth sitting with for a moment. An exchange requiring participants to prove that their futures positions are tied to real-world supply and demand, rather than purely financial speculation, is not a routine administrative update. It is an exchange trying to maintain the connection between its paper markets and physical reality. Both the export restrictions and the quota reform reinforce the same message. The Chinese market is tightening its grip on physical silver at the same time that Western exchange inventories are falling. Meanwhile, here is a figure from CME Group's own depository data that has not received the attention it deserves. Over the 60-day period covering January and February 2026, Comex delivered a volume of physical silver equivalent to 86.4% of its current registered inventory. In 60 days, the exchange delivered metal equivalent to nearly its entire deliverable stockpile, while simultaneously maintaining enough inventory to actually make those deliveries. That is only possible because eligible silver was being converted and new metal was being brought in, but the pace is extraordinary. The current withdrawal rate, according to the live Comex inventory tracker, maintained at goldsilver.ai using CME Group data, would exhaust registered stocks in approximately 70 trading days at an unchanged pace. That is not a prediction. It is an arithmetic projection that gives you a sense of scale. The historical parallel that gets invoked in almost every conversation about a potential Comex silver squeeze is the Hunt brothers episode of 1979 to 1980, and it is worth examining carefully, because it is genuinely instructive and also genuinely limited as an analogy. Between early 1979 and January 18, 1980, silver prices rose from approximately $6 per ounce to a then record high of $49.45, according to London Fix data, an increase of over 700% in under 13 months. Nelson Bunker Hunt and his brothers had accumulated an estimated 100 million troy ounces of physical silver and significant futures positions, representing roughly one-third of the world's entire privately held silver supply. On January 7, 1980, in direct response to the accumulation, Comex adopted what became known as Silver Rule 7, which placed heavy restrictions on the purchase of commodities on margin and effectively banned most new leveraged silver purchases. The consequence was swift. Unable to maintain their leveraged positions, the Hunts faced enormous margin calls as prices began to fall, culminating in Silver Thursday on March 27, 1980, when silver dropped from $21.62 to $10.80 in a single day. A consortium of U.S. banks provided a $1.1 billion emergency credit line to prevent the collapse cascading into the wider banking system. Here is where the 2026 situation genuinely differs from 1980. The Hunt brothers episode was driven by a single identifiable actor, a family using borrowed money to accumulate physical supply and dominate futures positioning. The current drain is diffuse. It is not one actor. It is the Silver Institute's 5 consecutive annual supply deficits. It is Chinese industrial users pulling silver for solar panels and electric vehicles. It is ETF inflows of 187 million ounces in 2025 alone, according to metals-focused data cited by the Silver Institute. It is the Shanghai Gold Exchange printing spot premiums that the arbitrage cannot close. There is no single entity to threaten, no single margin account to unwind. The structural dynamics are genuinely different in origin. Where the parallel does hold is in the regulatory response. In 1980, when Comex concluded that the physical silver market was under stress, it changed the rules mid-game. Position limits went from 5,000 contracts to 2,000 contracts in January 1980. Liquidation-only trading was briefly implemented. The exchange's willingness to alter the playing field when it perceived systemic risk is not ancient history. It is documented institutional behavior that any serious analyst of today's market must factor into their thinking. The United Kingdom dimension of this story runs through the LBMA, the London Bullion Market Association, which administers the global benchmark silver price through ICE Benchmark Administration, set at noon London time each trading day. LBMA silver inventories in London fell to near all-time lows in late 2024, reportedly around 827 million ounces total, of which approximately 551 million ounces was already attributed to unsecured ETF holdings. That left a float of roughly 276 million ounces, with no fully transparent accounting of how much of that is genuinely available for physical delivery versus already allocated to other claims. The silver lease rate, the cost of borrowing physical silver, spiked to 30% annualized in October 2025, according to market data. A 30% annualized lease rate for a metal is not a sign of a liquid, comfortable market. It is a sign of people willing to pay a very high price for the immediate use of physical ounces. The LBMA's analysts in their 2026 Precious Metals Forecast Survey acknowledged the extraordinary volatility, with one contributor noting that the combination of strong ETF purchases and historically modest LBMA inventories had driven silver to a new record near $83 per ounce by early January. According to Fortune's market data, silver was trading at approximately $83.96 per ounce as of March 9, 2026, more than $51 per ounce higher than 12 months ago. Now, 3 specific things to watch in the very near term. The first is the CME Group Daily Vault Report published each evening after the close of trading. What you are watching for is the direction of registered inventory. A sustained increase in registered stocks, meaning new metal is being warranted and added to the deliverable pool, would be the clearest database challenge to the current tightness narrative. Conversely, Continued net outflows at the pace of recent weeks would arithmetically compress the coverage ratio, the percentage of open interest that registered inventory could theoretically satisfy, toward the 10% threshold that analysts have historically identified as acute stress territory. The current coverage ratio, based on CME data, stands at roughly 14%, already in what GoldSilver.ai's Comex stress index categorizes as the stress zone. The second thing to watch is the May 2026 silver contract first notice day, which falls on April 30th. First, notice day is the first date on which holders of long contracts can be assigned for physical delivery. The pattern established in the February and March 2026 delivery cycles, unusually high delivery rates concentrated in the first few days after first notice, will either repeat, confirming a structural shift in how industrial users are approaching Comex, or moderate, suggesting the recent delivery volume was partially anomalous. Watch the CME Group month-to-date delivery report, published daily on the CME Group website. The third is any statement or announcement from the Shanghai Futures Exchange or China's State Council regarding silver export policy. The January 2026 restrictions were the first formal limit on Chinese silver exports in modern market history. Any expansion of that restriction, or any commentary from Chinese industrial policy bodies, would materially affect the arbitrage dynamics between Shanghai and Comex. If the premium between Shanghai and Western spot prices widens back above $8 per ounce and the arbitrage remains closed, that is the market repeating its most recent signal. To bring this into focus, here is what the data establishes with reasonable confidence as of this week. Comex registered silver has fallen 64% from its April 2020 peak of 240 million ounces to approximately 86 million ounces today, according to CME Group depository records. February 2026 physical delivery volumes set a modern record, with 25.18 million ounces delivered in a single month, drawn from CME Group's monthly delivery report. The Silver Institute's World Silver Survey 2025 confirmed a fifth consecutive annual supply deficit, with the cumulative shortfall from 2021 to 2025 reaching approximately 820 million ounces. Shanghai physical silver traded at an $8 or more premium to Comex futures in late December 2025 in a state of backwardation, with the arbitrage remaining stubbornly open because insufficient physical metal was available to bridge the two markets. And China has implemented export restrictions on silver effective January 2026, while the Shanghai Futures Exchange has tightened hedging requirements to ensure futures positions reflect real physical business activity. Taken together, these data points describe a market where the gap between the paper price and the physical cost of owning silver is wider than it has been since the liquidity squeeze of late 2025. What the data suggests directionally is not a price prediction. It is this: the structural conditions that tend to precede acute physical delivery stress, falling registered inventories, elevated delivery rates, persistent east-west price divergence, and tightening exchange rules, are all present simultaneously. Whether that resolves through price repricing, through a surge of eligible to registered conversions, through new mine supply, or through some combination of regulatory intervention and demand destruction at higher prices, the data does not say. What it does say is that this is not a noise event. It is a signal. And watching the daily vault reports over the next few weeks will tell you more about the direction of this market than any analyst forecast. The question for the comments, and I mean this as a genuine analytical question, not a sentiment poll. Given that the current Comex drain is driven by diffuse industrial and institutional demand, rather than a single concentrated actor like the Hunt brothers, what mechanism, in your view, is most likely to actually rebalance registered inventory? Eligible to registered conversion, new import flows into Comex vaults, demand destruction from higher prices, or something else entirely? Thank you for watching. All sources cited in this video, including CME Group vault reports, the Silver Institute's World Silver Survey, the LBMA Analyst Forecast Survey, and relevant delivery data, are linked in the description. This video is for educational purposes only and does not constitute financial advice. Every figure referenced here comes from named, publicly available sources, but verify every number independently before making any financial decision. The links are in the description.